Welcome to the Wanting to Wealthy podcast, where we discuss all things money, savings, business, and anything we should have learned in high school about living our lives in the financial world that we didn't. My name is Ashley Hogan. I'm your host, and today's episode is going to be about something called Profit First. Profit First is something that I recommend to all of my small business clients. And it helps us figure out a way to manage our cash. So, because small business ownership can be overwhelming in the first place, let alone trying to figure out everything we should or shouldn't be doing so we can run our business. So, if you're not sure how to set up all of your business accounts or how many business accounts you should have to cover all the things that are happening and coming up, like taxes and insurance, this is the system that I use personally. This is the system that I teach other people to use and suggest that anybody who's running a business should use. So, first and foremost, if you are running a business and you do not have a business account for your business, get that set up. Do not run a business out of your personal account. That's an absolute no no. It can get you in a lot of trouble in lawsuits, especially if you have an LLC or a corporation. But even for a sole proprietorship, it's a lot easier to tell and make sense of things if you're not running it out of a personal account. Most of the time, if you go to someplace like a credit union, this is going to cost you $5 because you'll need to set up another savings account and another account number. It's not a lot of money to do. It just holds that savings account for you, but it separates first your personal and your business accounts. Okay. From there, we're going to look at the Profit First setup for your business. You can do this for your personal too, but I'm just going to go over the business side today. So, Profit First is a book by Michael Michalowski. I cannot guarantee I said that correctly, but I'll put it in the show notes. And it's going to help you organize your money in a way that makes things easier to see where everything is going and help you um, keep it all straight and make sure you have enough money to cover stuff. So the idea is that you're not going to scramble for future cash because you used more of your working capital than you realized. And working capital, I'm going to give you a few vocabulary words. This is the cash that's going to help you run your business until you get paid because we don't always get paid in real time. And sometimes we have to pay for things for jobs before customers pay us. So typically speaking, um, many companies will hold, say, a 50% deposit before a job even starts. That's to help cover the upcoming expenses. But if you allow your customers to make payments, you still have payments that need to be made before all of your income is brought into your business. Working capital is the money you're going to use to keep your business running day to day. Okay. So, first off, there's going to be several accounts you're going to want to create. Most credit unions and other banks will allow you to create these either as money markets, high yield savings accounts, um, checking accounts, things like that. I always suggest you try and do high yield savings accounts or money markets so at least you can earn money on the money that is sitting there waiting for you to use it. Some of these accounts include, these are the basic ones: an income account, an expenses account, a profits account, a taxes account, an owner pay account. Those are your basics. I personally add a savings account and specialty accounts like a maintenance fund for a farming company or a maintenance fund for a construction company that's got to do maintenance on their equipment. I've seen other people use accounts like a property tax account, a prepaid insurance account, so they can start saving money so they can pay for all of their insurance in one go and not pay installment fees um, when you make monthly insurance payments. So, with that, You should ask the bank, or if you know how to do it, to name these accounts the things that I said. And then also, you're going to um, put a percentage of the profits that you're going to add into that account so you don't have to think about it. So, for example, you are going to have one that's just called income, okay? Then one that's just called expenses. What you're going to be separating out into the other accounts is your profits. And remember, profits are what you made after you covered all of your expenses for that job. So take away job supplies, take away your overhead, things like that. Whatever you have left over is your profits. From there, you can do something like I'm going to put 10% of my profits in the profits account. So, right, profits 10%. That's what that one should be named. Same thing with owner's pay. Profits, or excuse me, owner's pay 10%. Okay. Your taxes can do it a couple of different ways. If you're in a company that's just starting out, you may just be paying for the cost of having your taxes submitted, and you might not be making any money that you need to pay taxes on yet. So you could use a number like 5%. So 5% goes to taxes. If you are in a higher tax bracket, say your company pays 22% taxes, you should put 22% in there. And then adjust that. You can always adjust these if you find out that you're putting too much or not enough in one of these accounts. Okay. Then you can choose an account for, or choose a percent for all your other accounts. So it might be that your property tax is only 1% of what you make in a year. So you just put 1% in an account, but then it's there. You're not then trying to pull it out of your expense account. Do this from the income account. So then the only thing you're seeing in the income account is money coming into your business, you distributing it. And then once you've distributed the profits, whatever's left from that money goes into your expense account. So we'll do a quick example. So let's say that you had a job that was $1,000 is how much you sold, is how much the job was for. Of that $1,000, 50% of it was 50% of it was out of pocket costs. Maybe you had to buy some materials, things like that. But 50% of it was profit. So $500 of that was pure profit. So what you're going to do is go down the accounts and say we did 10% to profits. So we're going to put $50, that's 10% of your profits, into the profits account. We're going to do the same thing for owner's pay. 10% of your profits into the owner's pay account. Say you use 10% for your taxes, you're going to put $50 into the tax account. Say you've got a insurance account that's 2%, you're going to take $10 and put that in that account. Okay, so then what we did is we take the $1,000 that was in the income account, we subtract 50 for profits, 50 for owner's pay, 50 for taxes, and $10 for insurance. So $840 is going to go to the expense account because you're going to be paying for those out-of-pocket material costs out of that expense account. Okay. So then that way you're not taking 10% of the whole amount of income, because you're going to end up getting to a point where you don't have enough money in your income, in your expense account, to cover your overhead and your other expense bills and your working capital. So that was just an example. I like doing this for every job. It's a lot easier to see. Then I can, and I write little notes to myself in the memos. So, okay, this was from the Smith job and this was from the Jones job. That way I know, okay, did I do my math correctly? Do we have something that we need to adjust so we have more profits? What items or what service was being executed to show us how much was profitable and how much of it, um, or what was profitable and what was not profitable. So there's a lot of details we can get into with this. Okay, so once you've set up your accounts, you've named them with the percentages, and then you have taken the money from the income account and distributed it. Let's talk about what are you going to pay out of each account, okay? So income, out of the income account, you are literally just going to pay or divide out your profits and then put everything else in the expense account, okay? For the profits account, this account is to reinvest in the business. So these are going to be things like you need a new piece of equipment, you need to change your software or upgrade your software. You need to add an employee, not for day-to-day expenses. So these are things that are going to increase your business, okay? Taxes. So your tax account is going to be for paying your tax bill. So if you do quarterly taxes, you need to pay out of this account. This is going to help also pay for tax prep and for any state fees. For example, in the state of Oregon, when you file your taxes on a corporation, you have to pay $150. It's a corporate state tax fee. Take it out of this account, okay? And then also owner's pay. So this is for the owner's draws or monthly or quarterly disbursements. This is so the owners, especially when we're in new businesses and all we're doing is just putting money into the business and putting time into the business, that we get something out of the business. That it's not just, okay, I put $50,000 into the business and it's kind of standing on its own 2 feet, but it still owes me $50,000, right? So this is going to not reimburse the owner for the expenses, but giving them a draw, giving them some sort of money out of the business. Also, if your owner is an employee, it's not coming out of this either. It's coming out of it as an expense in payroll expenses. Okay, so for the expense account, this is going to be your day-to-day expenses, your working capital. The goal here is that you have this working capital to cover monthly overhead bills like utilities and rent and stuff like that. Payroll, your payroll taxes should come out of your tax account. You should be moving that over into your tax account. But one could make an argument that the payroll taxes are being withheld within this account as well. So just kind of where you want to do it from. What else is going to come out of this account? Your cost of materials, maybe the fuel for your rigs. Anytime you need to buy more materials to make more items for your business, that all is going to come out of that expense account, which is why that expense account gets the most cash flow back into it, because part of it is profits that is going into that account, but part of it is just reimbursing it for expenses that it already spent money on, right? And then specialty accounts are going to be things very specific to those accounts. So if you could do a separate payroll account. You could do a separate insurance account, property taxes, maintenance, anything you want in our personal accounts. We have a separate vacation account and automotive fund. And the automotive fund, the only thing I pay out of that is our maintenance on our automotive, on our rigs. So you can do this personally as well, but it kind of helps you organize your money. So you're not just looking at one or two accounts and going, okay, well, I'm going to pay my taxes and hope I have enough money for everything else. And it gives you some peace of mind that if you're doing this consistently, you know when tax time comes up, you've got the money sitting in an account. When insurance time comes up, you've got the money sitting in an account. When you need to buy a new rig for your business because yours is 20 years old and it's finally not working anymore, it's not functional, you've got the money sitting in the account, right? Um, so hopefully this overview, I'm going to put the link to the Profit First book in as well. But hopefully this overview is helpful in allowing you and helping you organize your money. If you would like me to do this for a personal to do an example of this for a personal account or for a non-business account, let me know, because I can always do that as well, and show you how we use it on an individual level or on a family level. And it can get a little overwhelming if you get really tedious with it. If you have 25 different specialty accounts, it can get really overwhelming. So make sure that there are things that are easy for you to forget. So those are the things that are covered, like only paying your insurance once a year or twice a year, or only paying your property taxes once a year. Those types of things are going to help hold money in ways that you're not going to be scrambling when those onesie twosie things comes up each year. So thank you for listening. As always, DM me on Instagram if you have any podcast ideas, thoughts, questions, or concerns. I also have a Patreon membership where I send out weekly reminders of things that sometimes we don't think about, tools that we can use, and previews to YouTube videos, extra content, and more information. Thanks for listening.